Hey friends, welcome to the Stratonia podcast. This show is all about strategy, entrepreneurship, and smart business thinking, especially for African founders and professionals. I share lessons, tips, and insights from years of building businesses, and if you want to grow smarter and run better businesses, this is your podcast. Today we will be diving into our blog post focusing on loan applications. Yes, we are diving into the often frustrating world of accessing finance for SMEs, particularly here in Ghana. If you're an entrepreneur who's applied for a loan, you probably know the feeling you put in the effort, submit your application, and then rejection. It stings, it can feel like a roadblock, but what if we looked at that node differently? Accessing finance is consistently one of the top hurdles for SMEs in Ghana. But the good news is, a rejection isn't usually personal, it's feedback. It means the lenders saw too much risk. And understanding why, that's the crucial first step to improving your application and maybe getting that yes next time.
Exactly. Think of it from the lender's side. Their primary goal is, quite simply, to get their money back. When they look at your application, they're trying to assess how likely you are to repay the loan on time. Any uncertainty or red flag in the information you provide, that translates directly into perceived risk. Our guide for today, a comprehensive blog post, it really breaks down the 5 most common reasons loan applications get rejected for Ghanaian SMEs. And what's powerful about this source, I think, is it doesn't just list the problems. It offers practical, actionable steps to fix them, almost like building atomic habits for your business health that make you finance ready. It's based on real lender perspectives and the realities faced by entrepreneurs on the ground here.
Perfect. So, our mission in this deep dive is to really unpack these 5 deadly mistakes using this guide as our map. We want to show you what the lenders are really looking for and what concrete steps you can take starting today to build a stronger application and, frankly, a stronger business overall. Let's get into it. All right, let's unpack the first big reason applications stumble, according to our source: inadequate financial records and poor monitoring. This sounds obvious, maybe even a bit tedious, but why is having solid financial data so critical for a lender?
Oh, this is absolutely fundamental. The lender needs proof your business is healthy, proof it can generate enough money to repay the loan. They want to see clear, consistent numbers on your revenue, your costs, whether you're making a profit, and critically, how cash flows through your business. Without reliable records, they simply cannot verify your financial health or, predict your future ability to repay. It signals disorganization, maybe mismanagement, and adds a huge layer of uncertainty. Lenders, they really hate uncertainty.
Okay, so for someone listening who maybe hasn't been keeping meticulous records, what are the starting points? How does our guide suggest building this habit of financial clarity sort of step by step?
Yeah, the key is to start simple right now. You don't need complex software from day one. The guide suggests maybe getting a Google Sheets template just to track your daily sales and purchases. Simple. And a physical receipt book, maybe from a local market like Medina, as the source mentions, essential for giving to customers. Get receipts for everything. And here's a really impactful, simple step. Use your phone. Create dedicated folders. One for receipts received, one for invoices issued. Snap photos of every single document as soon as you get it. Stop letting those little paper slips disappear. And this one. Well, this is pretty much non-negotiable for lenders. You must separate your business and personal money. Open a dedicated business bank account, or even a business mobile money wallet, mixing business income with personal expenses like chop money or school fees. It just makes it impossible to see the true financial picture of the business. Lenders see this as a major red flag. Seriously. Okay, so once you have tracking and separation, work towards creating basic financial statements. You can learn how yourself, there are free resources, or pay someone affordable to help you generate monthly profit and loss statements. That's your income minus expenses. Shows if you're profitable. And cash flow statements tracking the actual money moving in and out. These give the lender the summary they need. And of course, systematically file all your receipts and invoices, paper and digital. Keep them organized.
I like that the source mentions specific, accessible tools too. Google Sheets templates are free, Wave Accounting has a free tier, and Zoho Books is an option if you're scaling up. Makes it feel doable.
Absolutely. And you see the power of this in the example given Anna, a skincare entrepreneur in Kumasi. She used to just track things on random paper scraps. Messy. She switched to a basic Excel sheet and started using a dedicated business mobile money account. Within 3 months, she could see exactly where her sales were coming from and where her expenses, even small ones, were going. She found financial leaks she didn't even know about. That clarity didn't just help her manage better, it was the foundation for securing a loan for ingredients later on. It's about building that visibility.
Right, visibility. Okay, moving on to the second mistake highlighted. Insufficient collateral or guarantees. This is often the first thing entrepreneurs worry about, isn't it? I don't have property. Why is collateral so important from the lender's perspective?
Collateral is, quite simply, the lender's primary safety net, their fallback. If, despite a solid plan, the business faces severe difficulty and, well, cannot repay the loan, the collateral is an asset they can potentially sell to recover some or all of their funds. So if you don't have enough assets they deem acceptable as security, it significantly increases the risk they are taking. That's the bottom line.
So if someone feels they don't have significant traditional collateral like land or buildings, what are the practical steps? Or maybe alternative options the source suggests they explore?
Okay, first, do a thorough inventory of all your business assets. Everything. List everything the business owns that has value machinery, equipment, vehicles, even significant inventory sometimes. And for valuable items like vehicles, make sure they are properly registered. DVLA registration, for instance. Unregistered assets are much harder, sometimes impossible to use as security. Then, investigate asset registries. Ghana actually has systems like the Ghana Collateral Registry. It's specifically designed for registering movable property things that aren't land or buildings. Think equipment, inventory. Registering assets here can make them more acceptable to lenders as security. It can unlock assets you might not have thought of. Also, proactively ask about loan guarantee schemes. This is important. Look into programs offered by government bodies or business support organizations like GEA. The Ghana Employers Association often partners on these. These schemes can guarantee a portion of your loan with the bank, effectively reducing the collateral the bank requires directly from you. The guide also suggests considering different types of lenders or loan products. Don't just think banks. Some microfinance institutions or specific loan offerings might have more flexible requirements, especially for smaller loan amounts. Though it's important to note, as the source does, that interest rates can sometimes be higher with these options. So weigh it up. And finally, look, if collateral is genuinely a weak area for you, you must intensely strengthen the other pillars of your application. Really nail the business plan, have impeccable financial records, demonstrate your management capability convincingly. Sometimes strong performance in other areas can help offset lower collateral in the lender's overall risk assessment.
Right, so tools here are things like checking the Ghana Collateral Registry website, asking GEA about schemes, and just using a simple notepad or phone app to list out your business assets. Get it all down.
Exactly. And the example of Kwesi running a phone repair shop up in Tamale illustrates this perfectly. He didn't own any land, but he meticulously listed all his business assets, soldering equipment, testing kits, even his generator. When combined with a strong business plan, that detailed asset list helped him secure a microfinance loan. It shows that listing all relevant business property, no matter how small it seems, is crucial. It adds up.
Okay, that makes sense. Let's talk about the third common mistake then. A weak business plan and unclear strategy. Why is presenting a clear, convincing plan so vital for getting a loan beyond just having, a good idea?
The plans. This where you show the lender you know exactly where you're going. And crucially, how the loan fits into that journey and leads directly to repayment. A business plan is your operational and strategic blueprint. Lenders need to understand your vision, your business model. Who are your customers? How will you reach them? What's your growth path? And most importantly, specifically how the money they lend you will be used to generate the revenue needed to pay them back. Show the link. A plan that's vague, maybe overly optimistic, or doesn't clearly connect the loan amount to future cash flow. It just suggests a lack of strategic thinking. It makes the future performance of the business seem uncertain. And that uncertainty, again, it translates directly to risk for the lender. They need confidence.
So for an entrepreneur who maybe hasn't written a formal business plan before, what does the source recommend? How do you create something focused and credible for a lender without getting overwhelmed?
Yeah, don't overthink it initially. Start with a simple template. That's the advice. The source recommends looking for free templates online, like those available from B-Plans. Loads of resources out there. Focus on filling in the core sections. A clear description of your business, your products or services, your target market. A basic marketing approach, who's on your management team, and very importantly, your financial projections. And critically, have a very specific section on loan utilization. Be detailed. Break down exactly how every single CD the loan will be spent. Is it buying specific machinery? Model number, cost. Funding a certain amount of inventory. Covering specific operational costs tied to expansion. Spell it out. Lenders want to see the funds being deployed strategically to increase revenue or efficiency, something that directly impacts repayment capacity. The guide emphasizes focusing heavily on realistic cash flow projections. This is often the most scrutinized part. Show, maybe month by month, how you realistically expect money to come in and go out. Demonstrate that you'll have a comfortable surplus after covering your operating expenses and other debts. Enough to service the new loan payment. And please keep it realistic. Avoid wildly optimistic sales forecasts or underestimating costs. Lenders see this all the time. Base your projections on your current performance and achievable growth rates. Ground it in reality. Finally, before submitting, get feedback. Ask a trusted mentor, a business advisor, even a knowledgeable friend to review your plan. Get another pair of eyes on it.
B-Plan's free templates is the specific resource mentioned there for getting started. Useful tip.
Yes. And the example of Isi, the caterer in Accra, really shows the impact this can have. She was apparently rejected twice. After consulting the guide, she revised her plan significantly. The third time, she submitted a plan that wasn't just a general idea, but clearly detailed how a specific loan amount would buy 2 larger gas stoves, allowing her to increase her capacity, take on significantly more corporate lunch orders, and realistically double her revenue within 6 months. That clear, measurable impact. That's what convinced the lender. It was tangible.
Tangible results. Okay, let's move to the fourth point, which touches on the people element. Perceived management weakness or lack of experience. How do lenders evaluate the management team, and why is this considered a deadly mistake?
Right, because lenders aren't just investing in the business idea or its assets. They are investing heavily in the people running it. You, your team. They need confidence that you and your team have the skills, the experience, the professionalism to navigate the inevitable challenges of running the business, execute the plan you've presented, and manage the loan responsibly. If they perceive gaps in experience, maybe a lack of relevant skills, or just general disorganization from how you interact with them, it raises a significant red flag about the business's ability to succeed and ultimately repay the loan. And this perception might not always reflect reality, but it's based on the information you provide and how you present yourself and your team during the whole application process. It directly impacts their risk assessment.
Okay, so how can an entrepreneur effectively showcase their capabilities and maybe proactively address any areas where a lender might perceive weakness? What are the practical steps?
Highlight all relevant experience. Don't be shy. Not just formal work history. Include any workshops you've attended, training programs, even informal mentorship you've received. It all counts. The guide suggests creating a concise one-page CV or profile that specifically lists your relevant business experience. Attach it to your application. Demonstrating a commitment to learning and improvement is also really key. Show you're proactive. Mention any relevant training you've sought out, whether from institutions like GEA, universities, NGOs, online courses. Mentioning participation in workshops or having mentors or advisors shows the lender you are actively working to strengthen your skills and address any knowledge gaps. And if you know you have a weak area, maybe finance isn't your strong suit, or marketing, show how you are mitigating that. Perhaps you've hired a part-time bookkeeper, consulted with a marketing expert, brought in an advisor with that specific expertise. Demonstrating that you recognize gaps and are actively addressing them builds a lot of confidence. And crucially, simple professionalism. Demonstrate it in all your interactions with the lender. Be prepared for meetings. Respond promptly to requests for information. Be organized in your communication. This provides real-time evidence of your management style. It matters.
The source mentions resources like LinkedIn Learning for online courses or YEA Ghana for youth-focused entrepreneurship support as places to potentially gain relevant experience or training to bolster that profile.
Exactly. And the example of Abdul, who runs a laundry service in Ho, shows how different experiences can be framed effectively. He didn't have formal laundry management experience, but he highlighted his past experience in hotel housekeeping, emphasizing his attention to detail, his customer service skills. He also mentioned an online customer service course he'd recently completed. These weren't directly about laundry operations, perhaps, but they painted a picture of a professional, customer-focused individual committed to improving. That reassured the lender.
Interesting. Okay, on to the fifth and final deadly mistake from our source, poor credit history or existing debt burden. This one feels straightforward maybe, but let's discuss why it's such a major factor for lenders. What's the core issue?
It really comes down to predictability. Lenders use your past behavior with debt as a strong predictor of your future behavior. It's logical. If your credit report shows a history of late payments, defaults, or just significant difficulties managing credit, it suggests, rightly or wrongly, a higher likelihood that you might struggle to repay their loan as well. It increases perceived risk. Additionally, if you have a large amount of existing debt, whether business or personal cap, it raises serious concerns about your repayment capacity for a new loan. Lenders look closely at ratios like your debt-to-income or debt service ratio. Basically, how much of your income or cash flow is already committed to paying existing debts. If that ratio is too high, it indicates you might not have enough cash left to comfortably handle another loan payment each month.
Right. So if someone knows they've had some past credit issues or maybe they're currently managing existing debt, what steps does the guide recommend? What can you do to improve your standing before applying?
Okay, the first step is to address any existing issues head-on. Don't ignore them. If you have outstanding debts or past defaults recorded, work diligently to clear them. Negotiate payment plans if necessary. Get agreements in writing. Lenders often look quite favorably on applicants who are actively working to resolve past financial difficulties and can show evidence of doing so. It shows responsibility. And meticulously manage your existing debt now. This is crucial. Make sure all your current loan payments, even small mobile money loans or supplier credits, are paid on time, every time. Building a recent history of timely payments is incredibly important. Also, try to avoid taking on significant new personal or business debt immediately before applying for a major loan, as this will definitely impact your debt ratios negatively. Transparency is also key, as the guide points out. If there were specific explainable reasons for past credit issues, perhaps a documented period of illness, a job loss, a genuine one-off emergency, be honest with the lender. Be prepared to explain the situation calmly and provide evidence if possible. Show that it was an unusual circumstance and that you have since stabilized. Honesty can sometimes help build trust rather than hiding it.
And the source points to specific resources here too, like XCS Data, Ghana, one of the licensed credit reference bureaus where you can actually check your own credit status. It also mentions the Ghana Association of Microfinance Institutions to help identify licensed MFIs you might have borrowed from. And simple tools like phone reminders or Google Calendar just to keep track of payment due dates. Practical stuff.
Exactly, practical steps. And the story of Linda in Cape Coast, the boutique owner, really highlights the importance of cleaning up your history. She apparently had some old, unpaid mobile money loans showing up on her report. Small amounts, but damaging. Following the guy's advice, she focused on paying those off completely. Got receipts, got confirmation. After 3 months of consistent, timely payments on everything else and a now cleaner report, she was able to qualify for a 10,000 GHS inventory loan. It really shows that addressing past issues and demonstrating responsible behavior now can significantly improve your future chances. It takes time, but it works.
Wow, those are 5 incredibly practical, crucial areas. It really drives home the point, doesn't it? Loan rejection isn't necessarily a judgment on your business idea itself, but often on how you present its health, its stability, and its future potential to the lender through, well, concrete information and actions.
Precisely. Loan rejection is a common experience, unfortunately, for many entrepreneurs. But it absolutely doesn't have to be a permanent setback. Viewing it as specific feedback, as this guide encourages, allows you to pinpoint exactly which areas of your business's operations or presentation need strengthening. And look, addressing these 5 areas, putting in the work on your records, understanding and maybe leveraging your assets better, clarifying your strategy in a solid plan, showcasing your management capability, and building or maintaining a strong credit history. These aren't just tasks to complete for a loan application. They aren't just hoops to jump through. They are, at their core, the fundamental practices that build a resilient, well-managed, and ultimately successful business, whether you're seeking external finance right now or not.
So every no can be a lesson. And if you can, actually asking the lender for specific feedback on why your application was rejected, as the source suggests, that gives you invaluable direct pointers for next time. Don't be afraid to ask.
Absolutely. And as a final thought from this deep dive, drawing from the guide, maybe consider these reflection questions for yourself. Which of these 5 areas we discussed, inadequate records, insufficient collateral, a weak plan, concerns about management, or your credit history, which one feels like the most significant hurdle for your business right now? Be honest with yourself. And then, what one simple, actionable step can you take this week? Just one thing to start strengthening that specific area.
Those are powerful questions to sit with. Just pick one area. Take that single action. Building a finance-ready business, really just building a strong business, it's a journey, isn't it? Taking these small, consistent steps, these atomic habits we mentioned earlier.
It really is. Focus on building those strong foundations, piece by piece. You'll not only improve your chances with lenders down the line, but you'll make your entire business more robust, more resilient, and ultimately more ready for growth. Opportunities tend to follow strength and preparedness.